Hey there, and welcome back to the deep dive.
Great to be back.
So we've got quite the stack of material you sent over. Research papers, reports from big names like the BIS, NIST analysis, even some articles.
Yeah, it's a lot, but it all seems to circle around this really big question, doesn't it?
It does. Like, what happens when the features we know from traditional money, fiat currency, start getting mixed into the crypto world? We're talking tech design, economics, real examples.
Exactly. And that's our mission today, really,
Yeah.
to unpack all that. We want to pull out the key ideas, the challenges, the potentials, basically help you make sense of what's really important in all these sources.
Okay, sounds like a plan. Let's dive in. One thing that really jumped out at me, maybe because it seems a bit counterintuitive, was from NIST, the National Institute of Standards and Technology. They're looking into how you can actually build governance, like the kind of controls you see in managed fiat currencies, directly into a cryptocurrency system.
Yeah, it's fascinating, isn't it? They're deliberately trying to take those blockchain benefits, transparency, integrity, maybe even new kinds of financial tools using smart contracts,
Right.
and see if you can merge them with the compliance stuff, the oversight that traditional systems absolutely need.
So it keeps some crypto flavor. The source mentions it's still like cash in one way, that immediate peer-to-peer transfer. No bank needed right in the middle.
Absolutely, that directness is key. It retains that core appeal. But, and this is a big but, it's very different from physical cash notes
How so?
because it's account-based, fundamentally. Not like a bearer instrument, a note you just hold. It's tied to accounts.
Ah, okay. And that account-based structure, that's the hook for bringing in compliance, isn't it?
Precisely. That's the whole point, really.
Yeah.
The NIST design specifically builds in things like KYC, Know Your Customer, and AML, anti-money laundering,
Yeah.
built right into the protocol itself.
So you can only send funds if the other person is also approved, authenticated.
Exactly. And, crucially, it means these accounts could, following due process, of course, be subject to law enforcement actions, freezing funds, seizing them, things very familiar in traditional finance, but quite different from the early crypto ethos.
Yeah, that feels like a world away from the anonymous kind of outside the system idea many people still have about crypto.
It is a definite departure. But the goal here seems to be integration with the existing legal and financial world, not existing totally separate from it. The tech they describe, it uses a dedicated, permissioned blockchain.
Permissioned, meaning like you need an invitation to the party. You can't just join.
Pretty much, it's a controlled environment. Different permissions for reading data, writing data, publishing blocks. Only entities that are authorized, identity-proofed, can actually submit transactions.
Okay, restricted transactions, I get that. But what about seeing the data? You said only validators can read the whole blockchain. That doesn't sound very transparent.
Well, it's a balance they're aiming for. Transparency versus privacy. The validators, yeah, they see the full ledger. But users get controlled, partial visibility.
Like what?
Like your own balance, your own transaction history, that kind of thing. But, importantly, the management transactions changes to the system rules. Validator lists, those are visible to users. So there's oversight on how the system itself is run.
Huh. That's clever. Hide the user-to-user stuff for privacy, but make the governance actions public.
Exactly. And because it's permissioned, they can use a much simpler, lighter consensus protocol.
Yeah.
No need for the heavy lifting of Bitcoin or Ethereum, and no user transaction fees.
Oh, so how do the validators get paid?
The currency issuer pays them. Plus, since everyone is authorized, it's easier to build in protections against denial-of-service attacks.
But wait, if the validators have all this power and access, what stops them from, taking over, forming a cartel?
Good question. They describe a balance of power mechanism. Essentially, it's a voting system among the current validators.
Voting on what?
Voting on who gets to be a validator. And crucially, the results of those votes are public. So yes, it's permissioned, but no single group can just seize control of block publishing or change the rules on their own.
Okay, that makes sense. The source also mentioned different kinds of gateways, security gateways, visibility gateways. What do they do?
Think of security gateways like initial checkpoints. They handle incoming transactions first, sort of pre-processing them. It decouples the initial request from the final validation step.
Any parallels?
The source actually notes it's conceptually similar to things like Hyperledger Fabric in the enterprise blockchain world. And they suggest users should send transactions to multiple security gateways at once for resilience.
Okay. And visibility gateways.
Those are run by the validators. That's how users get that controlled read access. We talked about checking balances, history. They use efficient view functions in smart contracts.
So just read-only access.
Right. And the responses are signed by the validator, so you can check their integrity. Again, the advice is to query multiple visibility gateways if you get different answers. That flags a problem, triggers a public event transaction.
So users are kind of cross-checking the validators.
Okay.
Interesting. And the gateway addresses are public, but the actual validator servers are secret.
That's the idea. Layers of security and controlled access. Compliance built in, but specific points for users to verify things.
And you mentioned specific governance roles too, currency managers, validator accounts.
Yeah, currency managers are high level. They control the money supply, create, delete, set interest rates maybe. They vote on system policies. Validator accounts are the block publishers we've been talking about. They vote on who gets to be a validator, manage the gateways.
And their actions are public.
Their management actions, yes.
Yeah.
Like voting on validators, that's public for transparency. But regular user fund transfers, those remain confidential among the validators handling them.
They even mention different ways to create money, not just like printing it.
Yeah, like push-based funds just appear in your account. Or pull-based, where managers set rules allowing you to sort of claim or create funds yourself later up to a limit. They suggest that pull-based model could be more scalable.
It's pretty amazing how detailed this blueprint is for, well, building control into crypto. The sources do mention researchers are kind of split on this whole idea, right? Central bank digital currencies, managed crypto.
Oh, definitely. Some see huge potential, thinking it's the future. Others are really critical, calling it a non-case, often because they see immutability, the idea that crypto rules can't be changed as fundamental.
But this NIST paper seems designed to counter that specific argument.
Exactly. They're explicitly trying to show, look, it is technically possible to build these systems where governance can be integrated, where rules can be changed, where you can have fiat-style controls. They're laying out the how.
Okay, so that's the how you could build it. Let's shift gears to something that's already very much built and making massive waves. Stablecoins and DeFi, decentralized finance.
Right. Stablecoins have exploded. They're basically the main bridge now between traditional finance and the crypto world.
Yeah.
Designed to hold a stable value, usually pegged to something like the US dollar.
And the growth is just, wow. The BIS sources talk about exponential growth since mid-2020. What were the numbers? Like $120 billion market cap in late 2021.
Then over $200 billion by early 2025, and the sources mentioned maybe $240 billion by May 2025. It's huge.
Seriously huge. Not niche anymore.
Not at all. And their trading volumes, often bigger than Bitcoin or Ethereum. It's not just speculation either. People are using them for payments, savings, finding refuge during crypto volatility.
Yeah, the Archive source had some interesting data points on how stable they actually are. Looking at USDT, USDC, DAI. What did you take away from that?
Well, up to March 2025, it showed keeping that perfect $1 peg is tough.
Yeah.
USDC seemed the most consistent day-to-day smallest wobbles. USDT actually hit $1 dead on most often percentage-wise, but also had the biggest drops, like that 15% dip back in 2018.
Right, I remember that.
And DAI had longer stable stretches, but maybe a bit more daily variance than USDC, though nothing like USDT's big outliers.
And even in a crisis like the SVB failure impacting USDC in March 2023, it dropped about 10%, right?
Yeah.
The sources say they usually snap back to $1 pretty quickly.
And within days, yeah. That quick recovery is vital for them to work, but those DPEGs, they're definitely warning signs about underlying risks.
Yeah.
The BIS sources really hammer on that.
And speed is another factor, isn't it? The arcs of data, comparing transaction times.
Oh, yeah. Traditional ACH transfers, days. Visa, take days for merchants to get settled. But digital options like FedNow, seconds. Stablecoins on Ethereum, maybe 5-20 seconds. Faster chains like Solana, we're talking sub-second, near instant. That's a game changer for some uses.
And that speed and programmability feeds right into DeFi, right? Decentralized finance.
Exactly. DeFi is trying to replicate traditional finance, trading, lending, borrowing, but using automated code, smart contracts on blockchains, cutting out the middleman. Stablecoins are the blood flowing through those DeFi veins.
But the BIS, they seem pretty skeptical about the decentralized part. They call it the decentralization illusion.
They do. Their argument is, look, true, complete decentralization. It's probably an illusion because any system needs governance. Someone has to make decisions.
How does that work? If it's on a blockchain, isn't it decentralized by default?
Not necessarily the control. Who fixes bugs? Who decides on upgrades or parameter changes? Often that power ends up with holders of specific governance tokens. And who holds those? Frequently, it's the founding developers or major investors.
Ah, so the code might be distributed, but the power over the code isn't always.
That's the argument. They point to DAOs, decentralized autonomous organizations that run many DeFi protocols, starting to register as legal entities, like LLCs in Wyoming. That's centralization in a legal sense.
Interesting point.
And they also note, despite DAX's centralized exchanges, the CEXs still dominate trading volume, mostly because they're cheaper to use, even if DEXs offer more anonymity or that DeFi Lego composability.
In oracles, you mentioned those as a risk.
Yeah, oracles are needed to bring real-world data, like the price of oil or dollars, onto the blockchain so smart contracts can use it. But if the oracle feed is wrong or gets hacked, or if the entity running it manipulates the data,
It can mess up everything relying on that data. Loan liquidations, derivative pricing.
exactly, it becomes a central point of failure or manipulation, which leads right into the broader risks the BIS highlights for DeFi and stablecoins.
They seem pretty concerned.
Yeah, the picture painted is one of high leverage, potential liquidity mismatches, where everyone wants their money back at once, but it's tied up lots of interconnectedness between protocols and, crucially, no traditional safety nets like deposit insurance or a lender of last resort.
And stablecoins specifically are prone to runs, right? If people lose faith.
Absolutely. If doubts arise about the reserves backing the coin, are they really there?
Mhm.
Are they good quality assets? Is there enough transparency? Lack of regulation feeds into this too. A run forces the issuer to sell assets quickly, maybe at fire sale prices, which can spiral.
And the type of reserve matters hugely. Cash is different from corporate bonds, which is different from volatile crypto backing.
Totally. And all these risks get amplified by just, well, the normal profit-seeking and risk-taking behavior in finance. Plus, there's always the lingering concern about illicit use.
Money laundering, terror financing.
Right. The pseudo-anonymity in parts of DeFi, combined with patchy oversight, makes it potentially attractive for that.
So are these just internal crypto problems, or could they spill over into the main financial system?
That's the million-dollar question. The BIS says a direct bank exposure seems limited for now, but hedge funds, family offices, other non-bank players, they're increasingly involved, so you could see spillovers.
Like how?
Like if a big stablecoin fails and has to dump lots of commercial paper, that could cause funding stress for the companies that issue that paper or even banks holding it. And you have firms trying to build hybrid businesses connecting the two worlds, blurring the lines further.
They also raised a flag about monetary sovereignty, especially for developing countries.
Yeah, this is a really serious point from the BIS. They call it cryptoization. It's where people in a country start ditching their local currency for, say, a dollar-pegged stablecoin.
Why is that bad?
For emerging market and developing economies, EMDEs, it could be really damaging. The central bank loses control over its own monetary policy. Local banks might get squeezed out of funding. The country essentially imports the monetary policy of wherever the stablecoin is pegged, like the U.S. Fed's decisions. Managing foreign reserves becomes much harder.
And if a giant tech company issues a stablecoin with billions of users,
That amplifies the risk massively. An EMDE could end up dependent on a foreign entity for its critical payment systems, governance, reserve management, all headquartered elsewhere, making local oversight almost impossible.
okay, so huge growth, real innovation, but also really complex interconnected risks and these big questions about control and sovereignty. It makes that hybrid monetary system proposal in the Arcusy of Source seem like an attempt to thread a needle.
That's exactly how it reads. It's trying to find a way to harness the innovation of private stablecoins, but anchor it firmly to the stability and oversight of the traditional system, especially the central bank.
A two-layer structure. Private issuers, but backed by central bank money.
That's the core concept, yes. Ideally, 100% backing with reserves held directly at the central bank, like actual USD cash or equivalents at the Fed for a US-based stablecoin.
They called it a synthetic CBDC model sometimes.
Right, because it gives you some benefits of a central bank digital currency, a stable digital dollar equivalent, without the central bank having to manage millions of individual retail accounts directly. The stablecoin is still a liability of the private company, but it gets its credibility from that secure central bank backing.
And they'd link into fast payment rails, like FedNow.
Crucial part of the design. Instant conversion between the stablecoin and traditional dollars. That tackles the cash out problem, makes it seamless, transparency of reserves, secured liquidity all built in.
What are the main advantages they see?
Well, uniform value. Because of the 100% backing, it should eliminate run risk and stay pegged. It creates a programmable money layer on top of the existing dollar system for innovation. It could allow different stablecoins to work together, be interoperable, and, really importantly, segregated reserves.
Meaning?
Meaning if the private company issuing the stablecoin fails, the holder's money is safe because the backing assets are held separately, securely at the central bank.
And it preserves monetary integrity.
That's a key goal. The idea is that a dollar is a dollar is a dollar. Whether it's in your bank, your digital wallet as this stablecoin, or in a smart contract, it's all ultimately backed by the same base, central bank liabilities. It prevents private money from drifting away in value or trust from sovereign money. And the central bank could still oversee the total money supply.
The source had that Alice and Bob example, right, to show how it works.
Yeah, walk through Alice converting bank money to stablecoin via an app. Reserve go to the Fed, she pays Bob or uses DeFi. Bob, maybe a merchant, gets the stablecoin and instantly converts it back to regular USD, just showing the potential for smooth integration.
And they did that what if using the SVB-USDC event.
Right. They argued this hybrid system, with its 100% central bank reserves, maybe even a Fed liquidity backstop, mandatory interoperability, segregated funds, it could have potentially stopped or seriously lessened the depeg and the panic compared to what actually happened.
Sounds good on paper, but there must be hurdles.
Oh, absolutely. Massive ones. Regulation is a huge question mark. What is this thing legally? E-money, a security, a commodity, no global agreement, jurisdictional clashes. How do you protect consumers properly? How do you manage the systemic risk if one of these private issuers becomes enormous? Lots of open questions.
And they compared it to a full retail CBDC, like China's digital yuan.
Yeah, they acknowledged a direct CBDC might get adopted faster, give the central bank total control. But it also brings huge privacy worries, big challenges integrating with existing systems, and requires building incredibly robust cyber defenses from the ground up. The argument is the hybrid model might be a better balance, at least for some places, leveraging private innovation while adding public stability.
Getting the digital benefits without the government running everything. Makes sense. Okay, let's wrap this up by looking at one last angle, this idea that maybe fiat and crypto aren't enemies, but could actually coexist.
That's the theoretical argument from the IJSRP source. It suggests that regular fiat currency and cryptocurrencies, specifically ones with real functions, not just speculation, can actually live side by side in an economy.
So not necessarily one replacing the other.
Not necessarily. The theory says the choice people make, hold fiat, use crypto, use both, depends on things like the perceived cost, volatility, inflation, versus the actual utility or functionality that crypto offers, especially as the technology improves.
And this builds on some classic economic ideas.
Yeah, the authors connect it back to Keynes, his thoughts on why people hold money, adding technology into that equation, and also Hayek, his critiques of central banks, ideas about credit cycles, maybe even market-based money.
And there's a demand curve for crypto based on this functionality.
Right. Demand isn't just random. It's driven by what the crypto can do. An equilibrium can be reached where the amount sellers accept matches what people want to hold and use. And importantly, they say different equilibria are possible. Coexistence is a stable outcome in the model.
El Salvador comes up as the big case study here.
Yeah, making Bitcoin legal tender in Sept 2021, huge deal globally. The source suggests their motivations fit the theory. Trying to get some distance from U.S. monetary policy because they use the dollar, making remittances cheaper, boosting the economy through digital tech.
But that move got a lot of pushback, didn't it? World Bank, IMF, rating agencies.
Oh, yeah. Big concerns were raised about money laundering, illicit finance, credit ratings, financial stability, standard criticisms.
But the author of this paper sees it differently, not just pro or anti-Bitcoin.
They argue El Salvador isn't necessarily aiming for substitution replacing the dollar. It's more about fostering coexistence, making Bitcoin a viable alternative alongside the dollar. And the government push for the Chivo wallet. They see that partly as pushing the technology that enables this dual system.
What could that mean long-term for El Salvador if this view holds?
Well, the source speculates their economy might become less tied to U.S. cycles, maybe less vulnerable to external shocks, could improve how credit works locally, maybe boost growth, lower unemployment, if they manage it well, and leverage Bitcoin's features, even with its volatility.
So this perspective kind of sidesteps the whole is crypto money or not debate, calls it a false dilemma.
That's the core takeaway. Forget arguing if it fits old definitions. The real question, according to this model, is can fiat and functional crypto find a way to coexist, serving different needs, finding an equilibrium? It's not necessarily winner take all.
Wow. Okay. So we've gone from the technical possibility of building managed crypto through the crazy growth and real risks of stablecoins and DeFi, plus a potential hybrid fix, all the way to a model suggesting coexistence is the name of the game, maybe like in El Salvador.
It really paints a picture of just how dynamic and, frankly, complicated this whole space is. So
Hmm.
many different paths forward seem possible right now.
It really does. And thinking about it, if the tech exists to build in governance, as NIST showed, and if DeFi and stablecoins keep facing these challenges, and if coexistence is actually happening on the ground, it really makes you wonder, doesn't it? How does our whole idea of money itself and how finance works need to change in the next few years?
That's the big question to chew on, definitely.
Absolutely. Well, thanks for joining us for this deep dive today. We hope this helped untangle some of the key threads where traditional finance and crypto are meeting, clashing, and maybe even learning to coexist. Keep thinking, keep exploring,